And straight into one of the biggest numbers of the day, of course, we have the CEO of Alexander Forbes, that's Edward Kieswetter, in studio with us to take a look at their results. And helping me to unpack this, of course, is our market commentator for this evening. That's Joseph Boucher from J.M. Boucher Investments. Gentlemen, welcome. Edward, let's just start off with an overall reading of the numbers. If we just take a look at profit as one of those indicators, one is tempted to say this is a flat performance. How do you react to that?
I think a number of things. The first is we're in a transition year. We had the listing last year. So there's a lot of transitions. There's some costs that are dropping off, some related to the transaction. There's new costs relating to the management share trust that comes on. So making the year-on-year comparability a little bit harder. We give a lot of notes in our financials, but it still takes some reading to get used to it. Secondly, I think we do accept the reality that the markets have been tough. We need three things to grow in our core business. We need jobs to grow, and we've seen a contraction of growth by almost 2%. We need equity markets to perform well, and we've seen the equity markets misbehaving.
Right.
And
quite a bit of volatility.
We need generally just a good economic environment, and we've seen the economy contracting every time there's a restatement. Notwithstanding that, we've actually seen notwithstanding the fact that we lost almost 8,500 members in the funds that we administer, which obviously has a double whammy effect for us. First of all, it's members that we no longer administer and therefore no longer have income from. And secondly, the assets that follow through in our investment solutions is no longer there, and we therefore have a loss of income on that basis. So that is really just a reflection of the economy that we find in. Then in terms of the 2% growth, that's off the back of 9% top-line growth, which is credible growth in a very tough market. How do we then reduce it to 2%? Well, first of all, there's 45 million of rebasing cost. I spoke about the transitional year and the above-inflation increases in our rent, and then also a very conscious decision to invest for growth. So 21 million rand of that cost takes courage for us to stick to the strategy and not just to simply go into cost-cutting. And if you strip through some of that, our normalized operating profit in a very tough year would have been 7%, and that's what is reflected and posted in our results.
Well, thank you so much. You said obviously you've invested a little bit of money in, for growth. In what sectors have you been? That's possibly the first question. And the second, possibly, how does legislation, changes possibly in legislation, would affect your bottom line?
Great question, Joseph. So, I mean, very important for the listeners is when we talk about investment, because we're a knowledge-based company, for us, we invest through our income statement. It's not as we're buying big machinery and equipment and then amortize it. So investment for us is people, and in this particular case, mainly frontline people. We've invested quite a lot in growing our short-term insurance sales staff, and you've seen the results, a great 9% growth in premiums in a market that has only grown by 7%, and then also building, which has a more medium-term effect. We have a huge opportunity in the members in our base, but we need to scale up and build the capacity to help, because that requires a lot of awareness raising, education. So that's really where the big investment goes, and then some technology. So when we talk investment, it's straight into our P&L. Your second question, we're actually very excited and positive about the changes. First of all, we think the policy intent is absolutely the right thing. We as an industry have to work harder to give clients a better deal. And that puts pressure on us to manage more cost effectively. So we've seen in many instances us having to proactively look at pricing to give, to reprice our portfolios, but also to invest in the administration platforms to give a better service to our clients. And we've continued to do that. But we think, and we have to compliment Treasury for holding their line on the introduction of the reform. So what will it do for us? Default in-fund preservation means that the opportunity set to accumulate assets and savings increases for us, and we are right in the right spot to make virtue out of that, and we intend to do so. And then obviously by introducing default savings, Treasury also intends to drive the cost down to not give everybody this expensive advice in order to invest in.
So at a macroeconomic level, it certainly sounds like it's a good story for the consumer. Edward, I want to bring you back to the transition. Just give us a sense, given the context of the economy that we're operating in. We saw the recent quarterly GDP number and how close we skirted to a technical recession. At what point do these transitionary issues settle? And given the economy and the context, do you see the future of the next reading of your numbers going to likely be stronger, or are you headed into headwinds?
Well, I think most of us would agree that the revenue landscape is going to be tough for the foreseeable future. We don't see job creation picking up significantly. We see the market volatility to sustain and generally low economic growth. We face those headwinds. We have to stick to strategy. We have to make sure we continue to build dams while there's a drought.
Yeah.
And that really is to employ the staff. And obviously pacing that is always important, but we need to stick to strategy.
But that's a firm belief that it's going to turn the corner. So are you endorsing that you think economy-wise, we are going to turn the corner and it is going to get better?
If we don't believe that, Nozipho, then we can also be into a negative self-fulfilling prophecy. In our case, it's not just about the general economy. It is also about increasing our value proposition to members who are already in our funds,
right,
and to help them along to increase their savings, but also other discretionary products that they may buy. In terms of the first part of your question, so some of the costs that will drop off will be some of the transaction costs that brought us to the listing. And secondly, some of the costs that we will take on board will be the rollout cost of the LTIP, or the management incentive scheme, which over time will then fill into our base. And once it's in the base, then it'll be the incremental
We've
cost.
got less than a minute, so I want to give you a quick chance to ask your final question.
I was just going to say, where do you think the pressure is coming from? I mean, you've seen Signet just listing. I'm not quite sure how much competition they bring to Alexander Forbes. But from your performance, financial performance, where do you think the pressure will remain?
So first of all, Alexander Forbes is in the fortunate position that we don't have one single competitor because of the diversity of our business. And so that is just a natural the diversity, strength of diversity that we experience. We believe that the ongoing pressure will be a lack of job creation and just a sluggish economy. And then, of course, the equity market volatility doesn't help to that.
Right.
But the underlying factor really is a slow economy and no jobs.
And that was Edward Kieswetter. He is, of course, the CEO of Alexander Forbes, underscoring the lack of job creation as a key issue that the business is keeping its eye on.